equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I am excited for this interview. We often talk about real estate here. We dream of one day owning real estate. The great news is, until you can afford that home deposit, you can invest in real estate through the stock market. And we've got an expert here to help us understand this world.
It is our absolute pleasure to welcome Chris Bedingfield to the studio. Chris, welcome.
Thank you very much, Bryce. Alec, great to be here.
So Chris is the Principal and Portfolio Manager at Quay Global Investors. He has more than 30 years of experience working as a real estate specialist with a background in investment banking, equities research, and investment management. He's co-founder of Quay Global Investors and co-launched the Quay Global Real Estate Fund in 2014 that we're going to be unpacking today.
So Chris, before we get into the world of real estate investing, we always like to start with the story of your first investment. So to kick us off today, how did you get started?
Oh my God, it's a shocker. So I left school and I didn't know what I was going to do, to be honest. So I took a year of work and I worked for this little merchant bank called Rothwell's. Now, your audience would be too young to remember, but this was like high-flying 1980s, West Australia Inc., really dodgy loans. But anyway, I was just, believe it or not, my job was to courier, this is, when faxes were not even that used. I used to courier documents around the city. That was just a runner. Anyway, so I earned a bit of money and they said, you should invest in Rothwell's. And so that's what so I bought some shares in Rothwell's, which I think, it was like September 1987, so it was like a month before the stock market crashed, and of course, it was only downhill after that, so it wasn't good.
And so, Chris, following on from first investments, you've obviously then had plenty of experience in markets and figuring out what investment style works for you. So, how would you define your investment philosophy? Again,
when I left uni, I worked in stockbroking and I was a research analyst and I fell into real estate, to be honest. So my background is just finance and accounting, economics. I didn't study real estate at uni. And when I was sort of working in that stockbroking area, I started investing in all sorts of things, technology stocks and oil and gas companies, resources. And what I quickly discovered and what shaped my philosophy was that, stick to what you know and what you're good at. And if you're not good at it, then let someone else do it kind of for you. I'm not an oil and gas specialist. I'm not really on top of tech, but I do understand real estate. And so, pretty early in my career, I just started focusing, just investing in the real estate. I think that's the biggest thing individually. What I take is the hard bit is to just constrain yourself and just recognize what you are good at and stick to that. And some things might be really exciting. Right now, energy is really exciting. And in the past, it was crypto. And it's really tempting to chase those things. But if you're not really good at it, it's better to constrain yourself. And that's really been my philosophy.
I love that idea of stick to what you know and then find other experts to invest in those other areas. And I think, for years, retail investors have sort of not been locked out, but, there's been high minimums to access some of those areas or some of those experts, and that's coming down and, more and more funds are listing on market. So it's definitely become more accessible for, people like Bryce and I to access experts like yourself. And part of that is Quay Global Investors that you launched the first fund, I think, in 2014. So talk us through, going out on your own, putting out your own shingle and starting your own fund. How was that process and what have you learned about markets along the way?
Yeah, happy to talk about it, but I'll go back a little bit to what you just said a moment ago about, retail investors. Not just retail investors, it's, the biggest and the smartest fund managers make that mistake as well. They start out picking stocks and then they're successful in that. All of a sudden they're commentating on bonds, they're commentating on macro, they're commentating on the thing that gets me most upset is when they start commentating on real estate with, every every fund manager worth their salt has called, the Australian property market a bubble for the past 20 years. It's just so it's a human thing. It's everyone does it. Don't worry about it. But in terms of starting Quay, I rolled out of investment banking in 2013. I've been doing that for around 10 years. And my business partner and I saw an opportunity in the global real estate space where it's a massive market. Like listed global real estate is bigger than the Australian share market, in terms of market cap. And there's nowhere near as many participants. Like there's millions of fund managers trying to eke out returns in the Australian share market, but global real estate really is a niche area, and there's not that many people looking at it. So it's hugely inefficient. And so we started in 2014 with that opportunity, and we decided that instead of trying to beat an index like what most of the peers try to do, we just set about with a philosophy of trying to do a CPI plus 5 strategy. And so we started that in 2014. We went out, we got our own license, we binded our own presentations, we became, we outsourced compliance, we wrote our own investment memorandum, and then in 2014 we seeded our strategy, which is an index unaware concentrated global real estate strategy. We seeded it with our own money. Have never taken a cent out since. This is back in 2014, and then we managed to get the 3 Fs. Like every fund manager that starts out, you need the 3 Fs to get going. Family, friends, and fools came in, and we got the fund going, and we just started building track record, and we got some interest from people in the marketplace because our early performance, thank goodness, was very good, and then Benelong about a year later, 2015. And we formed a joint venture with them. They take care of all of the, back office and marketing, and they converted our fund into a PDS. So we have, daily pricing. People can get in and out of the fund on a daily basis, and really we just sort of built the business from there. And it's been a blast. I've enjoyed every minute of it. My only regret is I wish I did it earlier. It can be scary going out on your own, but it can be a lot of fun and a lot of stress. And I don't really see it as work. It's just an adventure.
So, Chris, for those sitting there at home listening to this at the moment without any sort of real estate exposure in their portfolio, what's the sales pitch as to why real estate? Why should we consider it as part of our portfolio mix?
There's a couple of things. I push back against the idea that if you're going into global real estate, it's kind of like a proxy for Australian real estate. I'm more than happy to talk about Australian real estate separately, but the pitch for global real estate is that it's huge market, it's inefficient, as I was mentioning before, and if you look at the long-term returns for global real estate, they're very, very good. In fact, if you just look at this century from 2000 to 2021, say the last 21 years, global real estate has outperformed Australian equities, it's outperformed international equities, it's outperformed infrastructure, it's outperformed bonds, it's outperformed gold. So if you sort of think about the main asset classes, it's actually been a really good performer. And don't forget, in that time, we've had the GFC, which was bad for real estate. We've had COVID, which was really bad for a lot of real estate. A lot of real estate companies were asked to step up during COVID. And I would just say to people, it's if you're thinking about it in your equities mix, if you're thinking like Australian shares, global shares, infrastructure, global real estate is actually a pretty good part of that mix, but I would treat it separately to, say, buying a home in Australia or buying an apartment in Australia, because global real estate, it's massively diverse. When you, in our fund, for instance, we have exposure to things like data storage and self-storage, manufactured housing, which is really kind of a weird sort of sector, but also life sciences. So, those things are just not correlated with traditional real estate. They are very different. And so I would just say to people, you need to sort out your real estate situation in terms of where you live. That's one decision. And then separately, and when you think about investing in Aussie shares, global shares, et cetera, that's where you think about the global real estate as exposure.
Now, Chris, you've kind of already answered it, but I do just want to ask the question anyway to make it a little bit explicit, because everyone dreams of owning real estate. Less people dream of owning REITs. But I want you to make the case for listed real estate as opposed to its sort of unlisted peer. Why listed real estate?
When you're thinking about unlisted commercial real estate, you sort of get locked up. You don't have that liquidity. I think that's the biggest issue, and you don't have a lot of choice either. So in Australia, we have a really bland kind of asset mix in commercial real estate. It's office, industrial, or retail. And when you go listed, you just have incredible diversity across different types of asset classes and geographies as well. And I think the other thing to take into account is also, currency. You get currency diversification as well. So the big thing there is that you just get this diversification. You get liquidity, you get diversification of companies and managers, and currency as well, and choice. You just get this great choice. To give you an example, one of the best things to have owned in the last 25 years in the United States was self-storage. Self-storage is like, as it sounds, they're just simple boxes where if you're moving house and you need to, store your furniture for a couple of weeks, or if you're going overseas, you need to store, you pay your rent, you put it in a box and you go away. And, that business in the United States, if you bought a company called Public Storage in the US in the 1990s, you would have killed the index. You would have wiped out, you outperformed the NASDAQ, you would have outperformed the S&P, you would have outperformed everything. It's a wonderful, wonderful business. Right now in Europe has got, its self-storage industry is right at the beginning of that cycle. It's like going back in time in the US and being able to, invest in those companies, 20, 30 years ago. And so, those opportunities are really, really rare. It's very hard to get access to them directly as an investor, but in the listed space, you can get access to them. And in those sorts of stories, those long-term, 10, 15 year secular growth stories are just not available in the unlisted space. And I can say the same for senior housing. The population, I know your audience is at the other end of the spectrum, but the first of the baby boomers is turning 80 in just 3 years' time. They're going to need senior housing. It doesn't matter what central banks do. It doesn't matter what prime ministers do. It doesn't matter what presidents do. The population is just getting older every day. And that silver tsunami, we like to call it, is coming. And senior housing is just a really great way to do it. And you just can't get access to it in the unlisted space. But in the listed format, you can buy companies like Ventus, which is a $30 billion company, expertly managed, a massive portfolio, sensibly geared, and you can play that cycle in the listed space so much more easily.
Love that. The silver tsunami.
Yeah.
It's my parents. Chris, let's turn to the macro environment. We've seen interest rate rises occur around some of the major economies globally. We've seen 5 consecutive months of rate rises here in Australia. So I guess simply, what does this mean for your investment approach, and how are you actually thinking about the macro environment at the moment?
I think one of the best things that investors can do, if you're a long-term investor, I would pay less attention to the macro environment than what a lot of people do. I mean, it's great for clicks and it's great for, people to sort of like get their attention to talk about what central banks are doing here and there. But it really is, if you're a long-term investor, it really is just noise. If you look at the long-term returns, say let's take the US market, the S&P 500. If you look at the total return of the S&P 500 between 2010 and 2020, 100% of your total returns came from dividend yield and earnings growth. 100%. There was no sort of PED rates or re-rates. There was none of that. And you think about that period between 2010 and 2020, you had quantitative easing going on around the world. You had interest rates, falling secularly going around the world. How many times people were talking about all this nonsense, and all that really mattered was dividend yield plus long-term earnings growth. And if you think about share markets over a long period of time, that's pretty much the same thing. And I would say exactly the same thing about real estate. People get caught up thinking that real estate is just this big interest rate driven sort of story. And nothing can be further from the truth. The best performing residential real estate market in the world right now is Turkey, which is up 100% just in the last 12 months. And interest rates in Turkey are 15%, 16%. One of the worst residential performing markets in the world right now is Japan, and interest rates in Japan are 0. You can sort of get caught up in this idea that interest rates are really important and the macro environment's really important. But if you're a long-term investor, you need to just get the asset class right, get the initial valuation right. And so long as you've got a bit of a growth story and your initial yield is okay, that's where your total return kind of comes from. And so, I sort of disarm people a little bit when they say, how's the macro environment affecting the way you think? on the way you're investing? And my answer is it doesn't really affect the way I think at all. It's so easy to just jump at shadows when, central banks right now are raising interest rates, but they're going to pivot at some stage. And are you going to be the person that's going to be ahead of everyone else when they pivot? Like, seriously, you've got no chance. So why play that game? It doesn't make any sense.
Well, Chris, you said talking about the macro environment is great for clicks. I want to ask you another question that's great for clicks about residential real estate here in Australia.
Yeah.
But first of all, we're going to take a quick break to hear from our sponsors. So, Chris, before the break, we spoke about why real estate, why listed real estate. We spoke a little bit about the macro economy and why you think in conversations about interest rates are great for clicks, but maybe not for returns. I want to turn to residential real estate because it's always front of mind in Australia, but especially now because we have seen a pullback in some of the major cities, Sydney and Melbourne in particular, after just an unbelievable couple of years. I know you invest in global real estate, but do you have any thoughts on Aussie residential at the moment?
Yeah, I definitely always have thoughts on Aussie residential. I think this is an asset class that I think people desperately need an education on, because it just frustrates me whenever I read the economists or equity managers becoming these self-styled experts in this space, and they really do miss the mark. The best way to think about residential or real estate generally, but we'll focus on residential, is there's a cycle and there's a structural element to real estate. The cycle is, driven by a combination of sentiment, fear of missing out, or panic, and that's largely driven by interest rates in the short term. We're seeing that right now, and so access to funding and cost of funding creates this sort of cycle over time. And right now we're seeing, as you quite rightly point out, we're seeing some softness in residential prices, and I expect that to last at least for the next 6 to 12 months. And then there's a structural element, which is very different. The way to think about real estate is that it prices itself around replacement cost over time. If you can buy an office building in Sydney today for, call it, $100, and it costs $100 to build, right? In 20 years' time, if it costs $200 to build, it's going to be priced at around $200. Otherwise, the development equation doesn't stack up, and you'll never get another office building built in Sydney ever again. When you explain real estate in that context, people kind of get that straight away. And what they miss in that conversation is you haven't mentioned interest rates once in that conversation. So what happens is that prices move around replacement cost over time. And that's why, from a macro point of view, we don't really worry about interest rates too much. If we buy our underlying investments below the cost to build, we're going to be protected to the downside, and we'll get a CPI plus lift to the upside over time as the cost to build gradually increases. And so when you're thinking about real estate in Australia, residential real estate, for a variety of historical reasons, we've made it extremely expensive to build in this country. And that goes down to, planning, government sort of charging taxes and rates and charges. Costs to build a house in Sydney out near the Dingo fence, it costs, 40 cents in the dollar of the construction cost to government rates and taxes and charges. Wow. You need to, that's why you get these, international investors come down saying that it's a property bubble, because they compare the price of housing to, the price of housing in Texas, and it's a completely different cost structure. You might as well compare the price of cigarettes in Australia versus the price of cigarettes in Texas, which is, wildly different as well. And so when you think about real estate in Australia, that's the secular, that's the long-term trend of what's going on. And so in the short term, interest rates going to move the market around, and sentiment and headlines. And I got very little doubt that over the next 12 months, we're going to see some more softness in the market. But if you're thinking about 3, 4, 5, 10 years out, you're going to have that sort of replacement cost. The cost of construction is always going up, and that's kind of like your underwrite. And we're seeing that right now in the data. We're seeing the market, we're seeing two things. We're seeing prices are falling, and we're seeing building costs going up. And so is it any surprise that we're seeing housing approvals fall? Is it any surprise we're seeing housing starts fall? Because developers aren't silly, right? They're not going to put $100 into a project to get $95 back. So they're going to move away, and they're going to start doing they're going to start building other things, right? And then you'll continue to get population growth. We're going to need more houses. And so the value equation has to stack up again, right? Otherwise the developers won't come back and build more. So, I would just say to people, I would say a couple of things to your listeners. I would say, look, beware of people who are not experts in this space trying to scare the bejesus out of you by talking about a house price crash, right? That's the first thing. Like, make sure that they're experts at what they do. I mean, I'm incredibly cynical when it comes to this. I just find that, sometimes you get a money manager who says, house prices are going to fall 40%, so you should sell your investment property. And then, oh, by the way, I've got a product that I can invest and I'll just charge you a nominal fee, right? It just really, and then the other thing that annoys me is these same managers who, sell their businesses, they make a lot of money out of their funds management business. First thing they do with their money is they buy a great big stonking house in Mossman or a great big stonking house in the eastern suburbs, So, do as I say, not as I do kind of mentality. So I would say just be wary of those sorts of commentary. And I know there's another global fund manager on the Fin Review today talking about another, big downturn. But anyway, and the second thing I would say is just think about it from the point of view that, so don't dream for a crash, right? I suppose that's the thing. Australian real estate is underwritten by, unfortunately, and it's a policy problem, is underwritten by very high cost of production. That's what really drives it over time. And if you buy sensibly, if you gear yourself sensibly, if you're patient, you'll look back in 5-10 years' time and you'll realise, hell, that's actually turned out to be, better than I thought. And the other thing I'd say is, for people that are sort of thinking about, making the plunge, is that there's a lot of talk about how investors get this unfair advantage of tax breaks in terms of capital gains tax and a negative gearing tax break. The best tax breaks in this country by far is your principal place of residence. It's the last tax-free asset you have, and so I would never, and I have done this many times. I have many people say, I'm saving for a deposit, I'm going to put my money into your fund, and I'm just like, just find something because your life choice is you're going to rent forever or you're going to buy, and so that NPV cost is there whether you like it or not. So I just think about it in that context.
So let's move to the commercial side. There's a lot of change in that space. There's been some pretty interesting, not demographic, but change since COVID took place with the work from home shift and the debate around will people be moving back to offices in the CBD, or is there the satellite approach now? Warehouse boom, e-commerce, there's plenty happening in that space. So let's start with the work from home debate. Which side do you sit on?
If the question is, are people going to work from home or are office values going to be okay? The answer is yes. And that's a deliberate sort of way of framing the question. Both are true. Both are true. So I see a scenario, and we've written a lot of papers on this. We see a scenario where work from home is here to stay, in some way, shape or form. I think employers have to be, very flexible about that. And at our business, we have a work from home policy, and we find that productivity is fine. So that's staying. So why are office values going to be okay? Well, when you think about it, and we had to do this whole process ourselves when we think about our business. When you start initiating a work from home policy, the second question is, well, how much space do we need in our office? And the answer to us, and I think the answer for a vast majority of office tenants, is the amount of space you need is exactly the same amount of space you needed before. The provision of space you need as an office tenant is for the maximum number of people in the office, not the average. Again, you see some commentary where a company might say, people are going to work from home. We're going to allow people to work from home 2 days a week out of 5. So that's a 40% reduction in demand. Well, that's not true, because if people decide to work from home on a Friday and a Monday, Friday is very popular in particular, then everyone's in on Tuesday, Wednesday, Thursday. And so as an office, as a business, and thinking about our office space requirements, it hasn't changed our requirement at all. I think what you're going to end up getting is you will get that work from home environment, but the amount of office demand is not going to change that much. And we're seeing it in the data. So we own a company in the United States called Empire State Realty. It's, as the name suggests, it owns the Empire State Building, but a bunch of other office buildings in Midtown Manhattan. Their leasing volumes are no different today than what they were pre-COVID, even though on average, the buildings are only occupied on a weekly basis, only occupied 44% of the time during the week. Now, of course, that's 10% on Fridays and it's 95% on a Wednesday. It means that the amount of space you need hasn't changed. So the exciting thing for us is that in the investment markets, people are trashing office values. And so we're we're taking advantage of that.
Yeah, I remember looking at Empire State Realty during the early days of COVID, and from memory, they got smashed, didn't they?
Yeah, so they did. I mean, office got, and that hasn't recovered. The other thing about Empire State, which is really interesting, is that it's office buildings, but up to a third of its income comes from its observatory deck.
Oh, wow.
The observatory deck. Yeah, the observatory deck. So the company makes EBITDA makes about 400 million a year, and the observatory deck makes about 120 odd million of that. So it's kind of a play on New York. It's kind of a play on tourism, and with everything opening up right now, people getting on planes again and traveling again, there's a massive recovery coming in terms of the observatory deck.
So, Chris, moving to the other big, I guess, COVID story when we're talking about commercial real estate, the warehouse boom. And we've seen some of the biggest players in the space like Amazon spend a lot and get a lot of real estate and now pull back a little bit. At the same time, we're seeing a number of e-commerce related companies struggle. Shopify is a big one that comes to mind. How are you seeing demand for for the warehouse sector, I guess? And what are your thoughts on this sort of longer term warehousing and e-commerce boom going forward?
There's no doubt that the secular demand for industrial has been really positive for the space for a long, long time. And COVID accelerated that as more and more people, shopped online, and companies needed to have good logistics and good warehousing to cope. I think that the problem is, from an investment perspective, is that the sector could be a victim of its own success. And what I mean by that is that real estate companies have seen the secular trend as well. Prices have gone way above the cost to build in industrial, and that's attracting a lot of capital to build more and more of these warehouse spaces. And remember what I was saying before about residential, prices go up in line with inflation over time. Well, what's been happening in industrial is prices are way above the cost to build. And as I said, that's creating a real surge in supply. And it's a risky time in that space because that surge in supply is coming just as e-commerce is normalising. And we are also hearing, in the US, retailers are saying they have way too much inventory. They stocked up during 2021 as the consumer came back post-COVID, and now everything's starting to normalise and they just have too much inventory. And too much inventory means they have too much warehouse space. So you're hearing stories like Amazon saying they've sort of overshot their expectation of online retail. Shopify is saying the same thing. Non-e-commerce tenants like traditional retailers are saying they've got too much inventory, and at the same time you've got a lot of new supply being built because the sector, as I said, victim of its own success, has attracted a lot of capital and a lot of new supplies as a result being built.
So, Chris, just before we move to our final three questions that we close all interviews with, we're just interested if you could perhaps talk us through one or two of the key holdings, no pun intended there, but some of the major holdings in the Quay Global portfolio, just to give a bit of insight into, some of the investments that you've got.
I'll give you one local that everyone should know, Scentre Group, which is the owner of shopping centres in Australia, or Westfield shopping centres in Australia. Now, this is the other side of that e-commerce story I was talking about. It's really clear in a post-COVID world that retailers are struggling to make money online. Distribution costs are really high, customer acquisition costs are really high. They need physical bricks and mortar space to complement their online offering. And so we're seeing tenants coming back into shopping centres in a major way. And customers are coming back as well, because the novelty of sitting in front of your screen at home and clicking on things you want to buy probably wore a little thin during COVID. And so people want to get out and about again. And you can buy Scentre Group at a massive discount to its book value. They just reported their results. It's really strong. Something a bit more interesting, though, and I touched on this a moment ago, is a company like Ventus, which is senior housing in the United States. 80-year-olds are their target market, basically, for senior housing. And the first of those baby boomers turn 80 in 2025. So that population bubble's coming through. And the good news is that you can buy these companies below the cost to build. So there's no supply coming in senior housing in the US at the moment, or very little, I should say. And the cost to build is going up, and you've got this huge demand story coming through. So great demand supply dynamic. A third company that we own, and we really like this space, is single-family housing in the United States. So post-GFC, the housing industry was completely decimated, not only from a price point of view, but from a industry point of view. A lot of people left the industry, a lot of workers left the industry. Now, in the United States, you need to build around 600,000 homes a year just to cope with replacement and general population growth. And post-GFC, they were building around 200,000 to 300,000 homes a year, so half what they needed. And they did that for 10 years. And so as a result, you've got this enormous undersupply of single-family housing in the United States. And as a result of that, you've got rental growth running at around 12, 13, 14%. And thank goodness you have Jerome Powell, who is raising interest rates and restricting supply even more as the builders, run for cover as they're worrying about higher interest rates, and the cost to build is going up very, very quickly. So these are really simple businesses. The company we own there is called American Homes for Rent. They own roughly 60,000 homes across the United States. They're 98% occupied, and the tenants are just paying their monthly rents. And unfortunately for them, but fortunately for us, their rents are going at about 12 to 13% per annum. And the market's undersupplied, and supply is getting worse, not better.
Just on that, that sort of style of company, that listed American company that owns a lot of residential property, Bryce and I often chat about the fact that we don't really see that in Australia. Now, that might be our naivety, and there might be listed Australian companies that own a lot of residential real estate, but you don't really hear about it. You hear so much about how well Australian residential property has performed as an asset class, but then you don't really see REITs spring up that own a bunch of it. Do you know why that is the case? Yeah,
it's, one of the best tax-free investments in this country is residential. It's rational for an owner-occupier to buy a house that has a yield of not much, 2-3%. Because if you get a 2-3% saving on your, on rent, which is basically what the yield on your house is, and you get a little bit of growth, that's an after-tax return of about 4 or 5%. That's a pre-tax return of about 8 or 9%. So Australian yields are structurally lower because of our tax structure, essentially. And so in the US, you get much better yields. You get much higher yields. So the company I was talking about a moment ago, American Homes for Rent, has a yield of, closer to 4.5%, 5%. And so the yields are a little bit better. So we are, as an industry in this country, moving down this build-to-rent industry, and I think you will see more of that product in the future. But the initial yields will be very, very low when you compare it, to global peers.
So, Chris, unfortunately, we have run out of time, but I firstly want to thank you for taking your time today to share with the Equity Mates community. It's an asset class that, firstly, we'd love access to in residential space, that's for sure, but that we don't often speak about a lot on the show. So thank you very much. But it is time for our final three, and we always start with a book recommendation. Are there any books that you would consider must read? Either in terms of investing or otherwise?
7 Deadly Innocent Frauds of Economic Policy.
Nice. Haven't heard of it.
I think it's one of the most enlightening books anyone could read. And I know that sounds a little bit inconsistent with what I was saying before about ignoring the macro, but it's really good from the point of view of understanding just how little macro kind of feeds through to investment decisions, but it also gives a great framework of understanding just macro from a policy perspective. Yeah, I couldn't recommend that book highly enough. It's by Warren Mosler and it's free.
Oh, wow.
So if you go to moslereconomics.com, you'll see a link to that book, 7 Deadly Innocent Frauds of Economic Policy, and it's a simple read. It's about 110 pages. Very, very simple read and very enlightening.
Nice. Love that. Love it that it's free as well. So the second question we always like to end with, forget the investment case for the company at the moment, forget its valuation, just purely on what the company is, what it does, and who it's run by. What's the best company you've ever come across?
I would say Equity Lifestyle Properties.
Okay, and why is that?
It's an incredibly powerful business model. It's a business model where the company owns the land and the tenant owns the house.
Oh, okay.
And there's just so many advantages to that. So first of all of the depreciation costs, maintenance costs, and upkeep is to the tenant. The second issue is that the tenant's not going to leave anytime soon. And a combination of both those factors means that the business generates heaps of cash and is immune to the cycle and is very, very recession resilient and very, very safe. So this business has never dropped its rents in 25 years. The rents have only ever gone up. You know, we've had pandemics, we've had GFCs, we've had rising interest rates, falling interest rates. The business is an incredibly powerful model. You're basically land banking when someone pays you rent and they take care of all the upkeep and you just get that land accretion over time.
Chris, I love that you have explained that model so well, because Bryce and I are looking at each other. We invested in a company that was trying to do something similar in Australia, Gateway Lifestyle Group. I don't know if that name rings a bell. Yeah, they got taken out by a big US company, Hometown, I think it was called.
That's right.
But you've just made the investment thesis more succinctly than Bryce and I ever could have. So thank you for that.
I don't know about that.
The biggest cost in real estate, it's a dirty little secret in real estate. The biggest cost in real estate is depreciation. And if you can get someone to fund that depreciation for you, and then you get the growth and the cash flows, you cannot beat that business.
If only Gateway was still listed. But Chris, we have got to our final question. And if you think back to your younger self, you know, starting out in investment banking, getting convinced to buy that first stock, what advice would you have for your younger self?
Back yourself. Just back yourself. It can be really scary to sort of put yourself out there from a business point of view and starting your own company or whatnot. But if you're young, what's your downside? Really? I mean, you fail and people kind of admire that you've had a go and you can always come back and get a job again. Like, I just think about my years as, 20, 30-year-old, whiling my hours away on weekends and late nights for other people when you could do it for yourself.
Love that.
I just think back yourself. Like, it's not, there's a lot of very average people out there who have become very successful. And I don't mean this in a disparaging way. There's nothing particularly special about a lot of people who succeed financially. The missing ingredient 9 times out of 10 is they just back themselves.
Well, Chris, awesome way to finish the interview. Something that Alec and I constantly remind ourselves of here, trying to launch a small business. So it's a great reminder to just back yourself in. So thank you so much for sharing your time with us and the Equity Mates community today. As I said, it's an asset class that we're all very interested in, and always hearing from the experts is very enjoyable. So we do appreciate it, and we certainly look forward to catching up again in the future. Thank you very much.
It's been my pleasure, guys. It's been fun.
Equity Mates Investing Podcast is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. Equity Mates gives listeners access to information and educational content provided by a range of financial service professionals. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Equity Mates Investing Podcast are not financial professionals and are not aware of your personal financial circumstances. Equity Mates Media does not operate under an Australian Financial Services licence and relies on the exemption available under the Corporations Act 2001 in respect of any information or advice given. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast or video. For more information, head to the disclaimer page on the Equity Mates website, where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Equity Mates Investing Podcast acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander people today.